December 6th, 2025. Silver just shattered every record in history, hitting $59.32 per ounce. But here's what caught my attention. Silver surged to fresh records above 59 Oz this week, making this its best calendar year performance since 1979. That's roughly a 100% gain in 1 year. While this was happening, major banks have reportedly been accumulating massive positions in physical silver. Some analysts estimate certain institutions hold significant percentages of global supply. Now, I keep asking myself, if silver doesn't matter like so many experts claim, why would major financial institutions be positioning themselves in this market? I've spent months studying historical financial collapses, and what I found is this: they all follow a similar pattern. 4 stages, always, and right now, silver appears to be in stage 4. Let me show you what I've discovered and why the next 72 hours might be critical. I've analyzed every major financial crisis in modern history, and they all follow the same blueprint. 4 distinct stages. Understanding where we are in this cycle could be crucial. Stage 1, the setup. Authorities create what looks like stability. Prices get suppressed. The market floods with paper promises. Everything seems fine. Everyone trusts the system. For silver, this started after what happened to the Hunt brothers in 1980. I'll tell you that story in detail later. But regulators got nervous about volatility, so they built something massive, a paper market. According to published COMEX data, the ratio between paper contracts and physical silver is significant. This means if even a fraction of paper holders demand actual delivery, the system could face serious pressure. Stage 2, expansion. The gap between paper promises and physical reality grows wider. Debt accumulates. Promises stack on promises, but prices stay suppressed. In my view, we've been in stage 2 since 2008. Bloomberg data showed silver-backed ETFs added about 200 tons on Tuesday, lifting total holdings to the highest level since 2022 amid robust demand. But here's what's really interesting. While demand increased, something else was happening. According to market data, every time physical demand rose, major market participants reportedly flooded the market with paper contracts, keeping prices pinned below $30 for nearly a decade. Meanwhile, industrial demand exploded. Industrial applications now account for more than half of global silver demand, led by solar photovoltaics, PV, electronics, and electric vehicles. Solar panels need silver for conductivity. Electric vehicles require roughly 3 times more silver than traditional cars. 5G infrastructure, AI data centers, medical devices. And here's the concerning part. Mine production has been decreasing over the past 10 years, especially in Central and South America. Metals focus. Project's 2025 will be the 5th straight structural deficit, with demand outpacing supply. So where's the difference coming from? Above-ground stockpiles, vaults, reserves, they're being drained. Stage 3, the break something fails. Could be technical, could be political. Suddenly, everyone wants the real thing, the physical asset, not the paper promise. And there isn't enough. This is where it gets really interesting. Let me show you what happened recently. On October 8th, 2025, an order for 1,000 tons of silver placed by India triggered an immediate freeze in the London silver market. Silver lease rates instantly skyrocketed from 0.25% to 200%. Think about that. Lease rates, what people pay to borrow silver, went from essentially 0 to 200% overnight. That's not normal market behavior. That's what happens when there's a scramble for physical metal. Then, on November 28th, 2025, the CME group, the exchange handling derivatives, reportedly went down due to what they described as a server cooling issue. During that outage, according to trading data, silver spiked to approximately $56.72 per ounce. When systems came back online, market observers noted massive bid-ask spreads. That's chaos. That's illiquidity. That's what happens when a paper market faces stress. Stage 4, eruption price explodes, shorts get crushed. Institutions positioned early win big. Everyone else is scrambling. December 6th, 2025. Today, silver hits $59.38. This represents approximately a 100% gain year to date, the strongest annual performance in over 45 years. In my analysis, we're watching stage 4 unfold in real time. To understand what's happening now, you need to know what happened in 1980. The Hunt brothers story is not just history. It's a warning and a blueprint. 2 billionaire brothers, Nelson and William Hunt, looked at silver trading around $6 per ounce and saw something others missed. Inflation, consumption exceeding production, a perfect storm. So they bought approximately 200 million ounces, roughly 1/3 of America's entire silver supply at the time. Then, January 1980 arrived. According to historical records, silver hit $49.45. That's roughly 800% in 18 months. Banks panicked. COMEX changed the rules overnight. They banned new long positions and forced liquidation only. No one could buy, only sell. Silver Thursday, March 27th, 1980. Crash. The hunts were destroyed, losing billions. But here's what matters most. The squeeze was real. The shortage was real. The $49 price was real. It literally took changing the entire game to stop it. Now imagine something with me. What if the buyers weren't two reckless billionaires this time? What if it was institutions that help make the rules? That might be what's happening right now. Let me tell you about what some analysts have observed regarding institutional silver positions. According to various market reports and COMEX data analysis, certain major financial institutions have accumulated significant silver positions over the past decade. Historical data suggests some institutions went from holding minimal silver positions in 2011 to accumulating substantial amounts of physical metal. Some analysts estimate these positions represent significant percentages of available supply. Why would they do this? Here's my understanding based on publicly available information. In 2010, certain institutions reportedly settled manipulation charges. When they acquired other firms during the 2008 crisis, they inherited significant short positions. They were on the wrong side of the trade. So what happened? According to market observers, they flipped, covered their shorts, went long, massively long. Recent COMEX data shows substantial silver holdings in certain vaults. Some analysts suggest these holdings represent significant portions of total COMEX inventories. Now let's talk about what's happening right now with inventories. A record volume of silver moved into London last month, tightening supplies in other hubs, while inventories in Shanghai futures exchange warehouses dropped to their lowest in a decade. Silver lease rates hit elevated levels as concerns about market liquidity increased after outflows to U.S. stocks and structural supply deficits. In October, the squeeze was such that traders had to pay much higher borrowing costs or lease rates to close their positions. Some people were having to transport silver by plane rather than on cargo ships to meet delivery demand. That tells me something significant. When you're flying silver across oceans instead of shipping it, when lease rates spike to unprecedented levels, when vaults are being drained, that's not normal. Let's talk about the fundamentals, because this is where it gets really interesting. The Silver Institute and related surveys show industrial fabrication at record levels around 680-690 million ounces, with solar panels alone consuming roughly 230 to 243 million ounces, about 19% of global supply in 2024. But production? Because over 80% of silver production is a byproduct of mining other metals like copper, lead, and zinc. Higher prices don't automatically translate into more silver supply. You can't just turn on new silver mines, and some existing mines are expected to shut down by 2030, potentially reducing annual production to around 901 million ounces from about 944 million today. The silver market is on track for a fifth consecutive supply deficit, with estimates of cumulative shortfalls running into hundreds of millions of ounces since 2020. Think about that. 5 consecutive years of consuming more silver than we mine. Where's the difference coming from? Existing stockpiles, and those are running out. London's vaults held 31,123 metric tons of silver in June 2022. By March 2025, volumes had fallen by around a third to 126 metric tons, its lowest point in years. Meanwhile, demand keeps accelerating. India's silver imports hit record highs. China has been purchasing consistently, and industrial demand for EVs, solar panels, and AI infrastructure keeps growing. The gap between supply and demand has never been wider. Now let's talk about timing, because the next 72 hours could be critical. December 9th and 10th, 2025, 3 days from now, the Federal Reserve meets to decide on interest rates. According to the CME FedWatch tool, bond futures traders are pegging the odds of a quarter-point rate cut at 87%. Multiple sources confirm similar probabilities. Market-based indicators, including the CME FedWatch tool and prediction markets, suggest approximately an 80% probability of a 25 basis point cut at the December 9th through 10 FOMC meeting. Here's my thinking on why this matters. Historically, when the Federal Reserve cuts rates, the dollar typically weakens. When the dollar weakens, gold and silver tend to surge. Gold has staged a dramatic rally this year, but right now it's silver that's stealing the spotlight. A squeeze in supply of the precious metal had catapulted it to a 100% gain as of early December, while gold was up 60%. Silver typically follows gold, but it moves faster, more volatile, more explosive. In my view, the Fed meeting could be a spark. The structural deficit is the tinder. Institutional positioning might be the accelerant, and a paper market under stress could be the explosion. All the pieces appear to be in place. Let's talk about where this could go. I'm not making predictions. I'm analyzing scenarios based on historical patterns. Silver is consolidating just below $60, with recent quotes around $58.3, $58.24. According to various analyst reports cited in market research, Early 2025 projections from major institutions suggested silver would reach $36 to $39 by late 2025. We are already roughly $20 above those targets. Some independent analysts have mentioned potential targets of $75 to $90 by end of 2026, but those are conservative numbers. Those assume the paper market holds together. What if it doesn't? Remember the Hunt brothers? We're currently at $59, but consider this. The supply deficit appears worse now. Industrial demand is exponentially higher now. The paper market is larger and more complex now. Historically, silver has tracked gold at various ratios. The gold-silver ratio has compressed to 71.8. Some analysts point to historical ratios, suggesting significant room for silver to catch up to gold's performance. When ratios correct, and historically they eventually do, the moves can be dramatic. Bank of America expects silver to average in the mid-50s in 2026, with potential highs near $65 Oz, driven by persistent deficits and green energy demand. But here's what concerns me most. What happens when holders of paper silver contracts demand physical delivery? What happens when they realize there might not be enough metal to cover all the claims? That's the scenario that keeps market observers watching closely. Now, let's be balanced here. I need to show you both sides. The bull case. Record supply deficits for 5 consecutive years. Industrial demand at all-time highs, vault inventories draining globally. Paper-to-physical ratio at concerning levels. Federal Reserves likely cutting rates in 72 hours. Institutional positioning suggests smart money is accumulating. Price already proving strength with 100% gains year to date. The bear case. Silver looks overbought and vulnerable to sharp corrections of 5 to 10 Oz, even within an ongoing bull market. A global slowdown, especially in solar, EVs, or electronics, could ease the strain on physical supplies. Prices could consolidate or correct before moving higher. Industrial substitution is possible. If prices stay high, market manipulation concerns historically have affected price discovery. The reality? No one knows for certain what happens next. Markets are unpredictable. What I can tell you is that the fundamentals, the technical setup, and the institutional positioning all point in the same direction. The signals are everywhere. Record highs, structural deficits, institutional accumulation, paper market stress, Federal Reserve meetings, all happening simultaneously. That's not coincidence, that's convergence. Stage 1, the setup, done. Stage 2, expansion and debasement, done. Stage 3, the break, happening now. Stage 4, the eruption, loading. I'm not telling you to buy anything. I'm showing you a pattern I've studied for months. You decide what it means for you. The Federal Reserve meets in 3 days. That's December 9th to 10th. Whatever happens next, we're living through a pivotal moment in silver market history. If you want to follow along as this unfolds, hit subscribe. I'll be tracking developments and sharing analysis in real time. Do you think silver hits $100 in 2026? Drop your thoughts in the comments below. I'm genuinely curious what you all think. This might be one of the most important commodity stories of 2025.